So the question right now is this rally real? I'm going to start off with you, Josh Brown. Is this a rally that you would continue to buy into? Do you have faith that this can continue to run?
So this is really why investing gets tricky, because if you think back to the start of the year, and if you were just going by headlines and not stock price, there would be no conceivable reason to believe that we would have a first half shaping up to be the way that this one is. It intuitively would make no sense. But that's not the way the market works. It's not designed to make sense or to make you feel comfortable at any particular time. And so let's just focus on where we stand right now, because my conclusion is that this has room to run. 10% of the S&P 500 components are making 52-week highs. Earlier this week, that reading hit 12%, which is the highest since April of 2022. That was the first bear market bounce of last year. So how do we avoid buying another bear market bounce is really the question. Like, how do we know that this isn't the same as that? I'm looking at average 14-day RSIs at about 60. That is one standard deviation above the mean, which is 50. Again, highest reading since summer 2022. When we talk about RSIs, all we're saying is that, opinions aside, mathematically, we've got an average stock that is in breakout mode. Like, that's most of the stocks in the index are looking pretty good. The Russell 2000 is getting stronger. This is really important. If you spend time talking to bears this year, their main argument, the crux of their main argument, aside from the economy, was that it's really just 7 stocks generating all of the return. Year to date, the IWM, which is the Russell 2000 Index ETF, total return is at 7%, trailing the S&P 500 by 10%, but still now positive. 49% of those Russell 2000 names are above their 50-day moving average. They're in short-term uptrends. That's a historic level for the Russell, and that's up 20% since early May. So you've got not just the big 7 stocks moving, but so let me finish my point, Frank. So it's not, what is this one variable that I follow, whether it's earnings growth or it's interest rate. It's the preponderance of evidence. When you look at the internals, you look at the technicals, and then you see that we're being led by growth and quality. Those are the 2 best performing factors this year. Growth is up 20%, quality up 15%. You say to the bears, all right, what else would you want to see to fall over into the bull market camp? Like I've just laid out, internals, technicals, the factors that are leading our quote, the right factors. Like what's missing? I can't think of what's missing, okay. And so that's where I fall in this argument.
Well, Josh, I want to follow up your point. According to our data team, it's actually 55 S&P 500 companies hitting 52-week highs. And it's really a broad variety of companies. Polte Group just joined that group today. I'm looking at McCormick, obviously the spice maker, Eli Lilly in the healthcare space. So, Karen, what is this broadness of this rally? What is it telling you about the sustainability of it?
Well, Frank, as Josh pointed out, the rally has started to broaden in just really the last month. If you looked at what happened up until the end of April, it was dominantly the top 7 or 8 mega cap names, and they're, the tech names and the large communications companies. Just in the last month, if you see small caps and mid caps, they've begun to do much better. And we needed that because you can't just rely on, less than a handful of stocks, 2 handfuls of stocks to take the market higher. So we're starting to see that. And why? Why is that? Because interest rates are peaking, and interest rates, of course, have a relationship with the economy. If we're not in a recession, which we are not yet, and we may not be in a recession, then that's another reason to feel better about the economy, for investors to feel that they really don't have many more opportunities to get higher and higher interest rates or bond rates, and they may move money, and they're beginning to move money into stocks. If you looked at the multiple of the rest of the market, other than the top names, it's in the sort of 16 times next year's earnings. That's not bad. That's really not. The multiple on the top names is much, much higher, particularly because of NVIDIA and Tesla. But if you say we're trading at a market multiple that we can accept, and there's a lot of stocks that have done nothing for the last year or two, then it's an opportunity. If these companies are going to make their numbers, we have many names in that category, in mid-cap, small-cap, even large caps. The financials, American Express sells for 13 times earnings. A lot of device companies. Healthcare hasn't done anything. Financials have been terrible. Industrials, a lot of opportunity there. So, yes, there is room to grow. Is there much room left on the top names? They're up 70+% as a group this year. Maybe not, but that's okay. The market can still go higher, even if some of them just hold steady.
All right, Steve Weiss, S&P right now above 4,400, about 4,430 right now. Are you seeing anything here that's making you a doubter? Do you believe that we can continue to run higher?
Look, I mean, this is one of the easiest markets I've ever seen to analyze, and one of the toughest markets I've ever seen to invest in. This is purely a momentum-driven market. Period. End of story. Josh does a great job in all the underlying data, and he's right. Carry, similar. You know, those are the numbers.